Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Now, anything can happen at any point in time. And you'll see a lot of activity. Those are the trades that I'm proud of. Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest and also author of the Options Playbook. So this week, looking at the markets, they've been a little scary. Oddly enough, September has underperformed all the other months of the marketplace, going all the way back to 1950. So if you only invested in the month of September, you would be down about 1% on your account each and every month that you invested in September, going all the way back to about 1950. Now, there are some up months. Obviously, there's going to be volatility, so you're going to have some up months and some down months. But September is always scary, and it's scary when you rally into the month of September. We had a very strong marketplace based off of earnings, I think, more than anything, that really drove us into September. And now everybody's kind of realizing that, oh, by the way, the Fed is not going to stop with their rate hikes. They're not looking to lower their interest rate in 2023 or any interest rate cuts. They're still going to be pretty hawkish, and that happened after the Jackson Hole speech by Jerome Powell. So the marketplace has now decided that, oh yeah, this possible recession is there. And one of the things I think we've been talking the most about is the European economies. They're really struggling with how they are going to heat their nation going into the winter months, and the geopolitical concerns are really affecting them. We've had a lot of news on those headlines recently that the natural gas pipeline between that Russia uses to actually send natural gas and just basically energy all across Europe, they're shutting it down, and they're doing it on purpose. And they basically just came out and said that we want the sanctions removed. That simple. So they were blunt about it. Oil today is up a little bit. We've seen a barrel of oil has actually increased a little bit over the last week. This has a lot to do with the natural gas situation and, just trying to come up with solutions for the issues in Europe. They're saying that it could easily go up by 200% their energy bill on a monthly basis. So that is just, that number is crazy. It's hard to even fathom. They're trying to battle with that. So I think that is still the main concern. So I'm having a tough time getting away from the energy space, and we're going to go back to the well again. Last week, that actually was the title. We went back and looked at Devon Energy, and we'll take a quick peek at that trade today. Not much has happened. That was more of a longer-term outlook. Today, we're going to speculate on a trade. We're going to use Exxon Mobil. We're just going to change it up a little bit. We talked about Occidental Petroleum when Warren Buffett and Berkshire Hathaway really made the headlines, talking about them adding to their position. Now they have quite a big position in Occidental Petroleum, good old OXY. So volatility is high in the space, and because of a lot of the news headlines. So we're going to actually just speculate this time around. We're not doing a fear of missing out trade or a longer term trade. we're just going to try to sell some of the volatility premium in Exxon Mobil. So we're going to look at a short put spread that's quite a bit out of the money because because volatilities are still high in a lot of these stocks. And we're going to try to sell some of that volatility. And I'm going to change things up a little bit because stock play of the day is all about trying to find a strategy that will fit market conditions more so than trying to always pick the right stock, right? We're looking at paper trades, we're trying to learn. And in this scenario, when we have pumped up volatility, which I've talked about the VIX being too low for a long period of time, well, the VIX is finally back up above the 25 level. And I feel a little bit more comfortable with it there, honestly, because the VIX was, as far as the marketplace was concerned, the actual volatility for the whole month of August was higher than the actual VIX index for an extended period of time. And that just doesn't usually happen. Usually you get wild swings in the VIX, but for the historical vol to be higher than the implied vol of the VIX index is just an odd occurrence. Going into September now, we got the actual vol joining in with the VIX, and the VIX finally had a little bit of a move up. So the fear index is, for the first time, trading around the 25 level, an area where I would kind of expect it to be at. So let's start by just looking at a chart. I have a trend line that I drew on my chart, and this is the VIX watch list. I guess let's summarize the markets before we get too far along. Surprised with the news in the energy space to see the S&P 500 index and the NASDAQ. They're up just a little bit, but it's better to be up than down in this space. We do have the Russell just down a smidge, looking at the IWM, the ETF that tracks the Russell. But to see the NASDAQ and the SPX hold their ground with the news that we have over the weekend about what's going on with Europe and their energy, I guess we could call it a crisis at this point in time. Oil is up a little bit, but based off of the USO that tracks oil futures. And then we see the VIX index trading about flat, but right around that 26 level. So if I look at the chart in the S&P 500 index, I actually drew a trend line. I didn't even touch this one because this was just a very interesting area in the S&P 500 index that we were trying to break through. We had, if you look at the moving averages, the yellow is 200-day, the green is 20-day, and the red is 50-day. We had over here what's called a death cross, where we had the marketplace, you had the 20-day crossing over to the 50-day. It's kind of a real strong phrase, and don't usually put a lot of weight in it. I think the S&P 500 index is something that that does really bounce off of moving averages a little bit more than maybe an individual stock. And after that happened, we did have a big downturn in the marketplace, but then we had a golden cross right here, and the market was really strong all the way back up to this is 4160 level. And we talked about this in one of the stock plays of the day. I think we actually did a trade that day in the S&P 500 index. And just an area of resistance, and we'd like to see it break through that area of resistance on the upside, or it might bounce and come back down. And we did I think we did a short-term butterfly and looking for a little bit of a down move when we were looking at this. Well, then we broke through. Guess what? Ran all the way up to the 200-day moving average and touched it almost exactly. And then the market started coming back down. Then we got into September. We hung out once again at the 4160 level, right where the trend line was. Like I said, I didn't even have to adjust it. I didn't even move that red line there. And now we've broken down, and it's pretty bad that we actually broke below the 20-day moving average. So we're in this area that just the chart doesn't look good. Let's be blunt. It was trying hard to get back to, getting our ducks in a row with the 20-day in front, 20-day over the 50-day over the 200-day, but it definitely did not want to break through that 200-day moving average. Okay, and we also kind of saw that here. We had a small breakthrough where the market was doing fairly well, but that ended up being a area of support and resistance. The 200-day is fairly important in the S&P 500 index, and I think a lot of people keep their eyes on it. Okay, so here we go. Devon Energy. stock play of the day last week. Right now, Devon Energy is trading about where the stock was at. Last week, we had the stock at 70.34. This is a 5-day chart, 15-minute chart. So we're only going back 5 days here. But we did have a good run up to about 72.50. Obviously, then we had the retreat and we went back down. Now, guess what? We're trading right where we're at. So not much to talk about on this trade. I would just stay the course. We did look at it as a longer-term trade. And a lot of the energy trades that we have looked at in energy stocks have been more so longer-term trades, fear of missing out, very basic, straightforward trades. We looked at selling a put to buy some stock. I think that was in Occidental Petroleum. Last week, we just looked at a long-term, long call spread going all the way out to October 21st. So we still have 45 days left in that trade. And if I look at the trade, here's what it was. We straddled the marketplace. Stock was right around 70. We went 6 points in the money, 5 points in the money and 5 points out of the money. We paid $4.80 for it. Guess what? It's trading for, well, $4.60. It was $4.80 when I started the call. It's down a little bit right now at that midpoint. You just stay the course. There's no reason. There's nothing to really see in the chart or in activity to try to scare you out of this trade. You know, we always watch for that 65 strike. If the stock does come down to that level, we'd be selling an at-the-money option contract because we would be long that 65 call. That would be an area where I would consider getting out of the trade based off of, well, where the market is at. If not, this trade, we've set it up where we have a 50-50 risk. We paid $480 plus commission for every 1-by-1 spread, with the goal of trying to make 520. So we managed our risk reward by doing a spread. Instead of just buying the option outright, we lowered the cost. We also reduced our upside, right? We gave up some upside to reduce our downside. So $480 is the maximum that we can lose on this trade. If you wanted to try to, say if the market did come down towards the 65 level, I would consider getting out. Or you could just say that if I lose half the money, so $2.40, if it's trading for that, I'm going to get out. On the upside, I'm going to try to make the maximum. Those would be my rules around a long call spread where I straddled the marketplace, where I basically, and you can go back and review the video from last week, we talked about buying the same amount of time premium that we were selling. So we're really taking that time premium factor out of the options, and we're just dealing with stock price movement. Now, time premium is still in it, still affects the prices, but by selling as much time premium as we're buying, we're not concerned about time decay. Price movement becomes king then in the option trading world. All right, so this week, we're literally going to speculate. I'm going to stay in the same time period. I'm going to talk about that. I've looked at short put spreads on a speculative basis on more volatile underlyings and doing shorter term expirations. Because Exxon Mobil, even though the volatility has increased, we're still trading right around that 40% level, which is high for Exxon Mobil historically. But we're going to sell a 45-day short put spread with the intention of getting out in anywhere from 15 to 20 days. So we're going to do some longer term time premium, which would allow us to make an adjustment if we're wrong on the trade. But as opposed to doing just a 20-day expiration and hope that it expires worthless, we're going to go out 45 days and with the plan that after 20 days, we'll probably close this trade out if it hasn't worked out for us or if it has. So our goal is based off of a timing forecast. Now, obviously, if we can get out earlier and capture a good chunk of the premium, we're going to. And what would have to happen in that instance is Exxon Mobil would have to go up fairly quickly in a shorter term fashion for us to be able to capture at least our goal. My goal is usually 80% of the premium. If you can get 90%, that's great. But we are going to go out longer period of time. Now, I always like to, if I'm going to do this on a, I guess, less speculative basis than doing the shorter term option contracts would be the way to say it. I do like that 45-day time period. I think the time decay and the curvature of time decay from a 45-day option down to a 20-day option. I think that's a very interesting period because if you're wrong on your forecast, there's still enough time premium to adjust. And if you are correct in your forecast, you don't get the time decay that you would on a 20-day option contract, obviously, but you get a decent amount and it makes the trade feasible. So if I were just doing short put spreads on, well, I mean, I'd say Exxon Mobil is more stable than most of the markets out there. Now, obviously, the news in the space creates some chaos, but if I'm going to do it on a basis like this, where I plan on doing them routinely, every month or so, I'm going to be doing short put spreads in a specific industry, maybe even in an ETF. This is the way that I would approach it. All right, and it's more hands-on. Just the fact that you get the opportunity to adjust because you're giving yourself enough time premium. So let's get into the trade. That was a huge setup. All right, so. I think I'll start by, let's go to look at a short put spread inside the options playbook. Okay. So I'm showing the options playbook. This is the short put spread. This is the book that I authored. And your goal usually is to be out of the money. You're hoping that the stock stays where it's at or drifts higher. You don't really want it to drift down, but you do got a small pillow to land on before it's going to get to your strike. But all your risk comes from strike B. So on the profit and loss graph, the stock is trading somewhere up here. We're going to go about the expected move away, which is almost one standard deviation. It's a little less. Expected move is always a little bit less than the one standard deviation move. And I'm going to highlight some of those things. I know those are big terms, but I'm going to highlight a little bit of probability of success on the trade. And we can use the delta of the option that we're selling to try to help us understand that a little bit. So that's going to be my goal today. We're always here to just try to teach, not necessarily make recommendations on these. We always consider them paper trades, but there we are. Now, before I get into the strategies, this is a interactive show and we want you to partake. So if you open up that chat box and you have any questions about this trade or last week's trade, feel free to put them in the chat box and I'll try to address them at the end of the show. All right, so now I'm going to run over. Let's start by looking at the chart in Exxon Mobil. And there are a couple of things that I find interesting in the chart. The 20-day moving average definitely seems to be acting as an area of support and resistance. Right now, we're hanging right at that level. It's at $95. We had a nice, strong up move once we crossed over. And once again, we have the golden cross where the 20-day crosses the 50-day moving average. Had a real strong move to the upside. Didn't quite get to the highs, but we had a strong move. Now we pulled back a little bit, but we're still hanging around that 20-day moving average. And ideally, we hope that it acts as support, that the stock just stays within that range and it can kind of pump up the stock because of the strategy that we're doing. Ideally, we'd like the market to run back up to that 100 level. But if it just stays where it's at, we can get some of the time decay. Hopefully a little bit of implied volatility may come off, and hence we can make some premium on our trade. Okay, so if I run over to the Ally Invest option chains, we see that the stock right now is down 27 cents. It's basically flat, kind of where the markets are at just in general. October 21st expiration, that's the normal Friday expiration, 45 days away. Like to trade in those expirations because they've been living a lot longer than just the weeklies. They don't just, as a weekly expires, then a new weekly opens up. In the monthlies, well, they start out on the normal rotation. So they'll start out as a 9-month option contract in some cases. And that means that more and more people are interested in it because you're going to see higher open interest. Just the options live longer. That's simple. So when I'm looking at a strategy like this and I'm going out to the October, I'm going to focus on the fact, what is the at-the-money straddle trading for? And so this, I gave a little bit of a heads up when we were getting into the trade that we were going to talk about this today. But I'm just going to round this off. It's a little bit more than 10 points. If I just look at the ask on the put, that's $5. The ask on the call is $5.70. So the midpoint would be kind of where we'd want to be. So we'll go, it's not an exact science, $10 and about 40 cents. So I'm going to go down to about that $10 level because we're saying that that move or that range is possible, right? But if it goes more than the expected move, well, that would be, and you're betting the over, if you will, on that trade. So that's what the marketplace is expecting. It never has any regard to direction, but it's a very simple thing to kind of give you, well, what's the marketplace kind of looking at? Another thing that we can look at is the delta. The delta here is 19. And that's usually about right where the expected move is at. So everything's, intermingled as far as option pricing is concerned. And a 20 delta means that there is a 20% chance. This is the non-textbook definition of delta, but a 20% chance that the underlying stock will not finish below that 85 level. So high probability of success if you ride this trade all the way to expiration. But that doesn't mean that the market can't come down, touch it, and go back up and come back down. It's just saying that, 20%, if the delta is right around that level, the probability of success on this trade is about 80%. Now, I always want to emphasize this. Somebody can come and they've said this to me many times before. You said it had an 80% chance of success. And I say, yeah. That means there's a 20% chance that it will go below that 85 level by that expiration date. And I've always say, well, have you ever seen a weather forecast? When they give a 20% chance of rain, how many times has it rained? It still can rain. They're not saying zero. They're still saying there's a chance that there might be some rain. You might want to stick that umbrella next to you in your car seat for the day. And so just keep that in mind, that even though it's got a higher probability, especially in the marketplace, that can happen. Okay, so I'm going to scroll down and we're going to look at the actual paper trade for the week. We're doing it for a 44-cent credit on a $2.50 wide trade. I would like it to be 50, and that's usually my goal. If I'm doing a 2.5 point wide spread, I would like to get 50 cents for it. If I'm doing a 5-point spread, I would like to get $1. Obviously, you can do the math there. It's pretty straightforward. So in this instance, I'm looking to bring in 44 cents. If we can close it for a dime, 15 cents, get most of the premium, I'm going to do that, especially if it happens in the short term. We get a good run up in Exxon Mobil, gets up towards that recent high. Well, maybe we can close this out for 10 or 15 cents. And that would be the way that I would approach it. Part of the reason why I like going longer is that you are going to bring in more premium, and trying to extract that last 10 cents of premium on a short put spread or a short call spread is really hard to do. You usually have to wait to expiration if you're trading shorter term option contracts. So this is part of the reason why I like to go longer term. And if I'm going to do this on a routinely basis, that also allows me to adjust because there's time premium in it. So if the market does go down to to my long put 82.50, I can make an adjustment at that time. I can turn it into a butterfly. I could maybe roll it or even just close it out because I'm going to have some time premium in it. Those are the possible things that I could do because I have a longer time period. All right, so let's put it in the right rail and make it the official paper trade. So here's what we're looking to do. Exxon Mobil, 95.38 right now, down about 23 cents. We're going to be selling the open, the October 21st expiration, 85 strike put, and buying to open the October 21st expiration, 82.50 strike put. We're trying to get this done for a net credit. I like the 44 cents. Let's put that in there at 44 cents. All right. No guarantee of a midpoint fill, but also and on top of it, you got to think about commissions because you're still paying commissions on option trades. 44-cent net credit to the account. That means for every 1-by-1 spread that we do, the maximum we can make is $44 less commission on the trade. Our maximum risk is $250, the width of the spread minus the net credit received. So you're looking at, 205, struggled with that. $2.05 is my maximum risk, or $205 for every one of these that we did. I'm going to manage my risk. If it gets anywhere near to $1, if I see this thing trading for $1 to buy it back, I would consider getting out of it. I'm going to try to make as much of the net credit as possible. If I can get, if it's trading for a dime, I'm probably going to close it. But the goal here is that if I bring in 44 cents, I usually don't want to lose more than the maximum I can make on the trade. So that's how I'm going to approach it on this trade. After 20 days, no matter what is going on in the stock or whatever, I'm probably just going to close it out. If I'm at break even at that point, I would just close it out and move on and go to the next trade. Hopefully we'll get a little bit of a move up in Exxon, and this will be one to watch. So we got two to watch now. We have Devon Energy long call spread. That's part of the reason why I'm doing a short put spread. I'll keep this one in mind, and I'll keep an eye on it. And at some point in time on a stock play of the day, we'll come back and we'll review this trade. So lastly, while you're putting the questions in the chat box and we're closing up this stock play of the day, I will show you the profit and loss graph on the short put spread. So this is where the underlying stock is at. You want the stock to obviously stay above 85. The dotted line is the expiration. This is, as of today, longer term option. And this kind of highlights that if it does get down to the 82.50 and it happens tomorrow, that the premium, the fact that you'll be selling an at-the-money option contract makes it a lot less painful if you're incorrect on your forecast. But it also means that if the market does run up, when you're doing longer term options, it takes a while or a good run up before we can make the maximum on the trade. So here they're saying, based off of implied volatilities, and this is all theoretical in nature, that it would have to get up to basically 102.50 if it happened tomorrow for us to be able to close out the trade close and get almost the entire premium of the trade. All right, so I'm going to run on over and look at some of the questions, see if we have any in the chat box. And it looks like we have a couple of them, and we'll address those. So here we go. Looking for a resource recommendation to learn options from a beginner's perspective. Well, obviously the options playbook, it's available. You can buy it on Amazon. It is available 100% free on the website, optionsplaybook.com. It covers the very basics of all option trades. Usually inside the book, it's only 2 pages to cover each and every strategy, just like the short put spread. How you select the stock to write the option on. And that's from Mohammed. I think that's right. Yep. And how did I select the stock? Oh, recently we've been talking about energy because that is the one space where it's been one of the strongest industries recently. We've had volatility in it, but it's one of the strongest industries recently. So we've looked at more than one stock in this space. Part of the reason why I'm looking at a short put spread in Exxon Mobil is that the implied volatility on those October options is right around 44%. If you look at Exxon Mobil historically, that underlying stock would trade around 25 or 30%. So because of the news headlines, we have pumped up implied volatility just in general on Exxon Mobil. So we're going to try selling some of that. And it's more so the contrast today between Devon Energy and the long call spread that we looked at, Occidental Petroleum and the short put spread or short put, cash secured put that we looked at. So I'm trying to say, all right, this is a space that we're interested in. These are 3 different ways that we can look at different underlyings, and we can use option strategies to try to fit our forecast for that space. So I guess the biggest reason, if I were to sum it up in one phrase, is that implied volatility is higher in Exxon Mobil than it has been in quite some time. So hence, we're going to sell some of that premium with a short put spread. Great question. Thank you. All right, this will be the last call for questions. We're coming to the end. I see we're right at the noon 30 hour, which is usually when we close things up. Thanks for coming, everyone. And please click subscribe, ring the bell, and we'll be back next Tuesday for the next stock play of the day.